Honestly, like I don't really want equity for lots of reasons, including, and I wish I had learned this as a result of being a brilliant financial engineer, but I learned it just by dumb luck, is if you've got an agreement on a CFE deal, and you've got, let's say, 10%, and the company goes out and raises money or brings in an operating team or something like that, and let's say that they're giving up another 10% of the company to that. Normally, you would be diluted pro rata.
I'm in the process of trying to figure out how to build a holdings group and in the kind of e-commerce pillar.
Okay.
And I currently have a couple CFE deals. And I originally started with one. I didn't know it was CFE, but that's how the owner actually pitched it to me. So it worked out.
Nice. Great.
But with them right now, I have a profit share off their gross profit, and they have their own definition, but it was agreed upon that it's just basically gross sales minus advertising costs, processing fees, and cost of goods to fulfill the product. And then there's a
Great.
percentage shared off that. So it's been working out, and we've experienced massive growth because they did not have a digital channel. They were all direct mail. And so from where we were at zero to where we are now is awesome. It's very big. The next idea that I kind of had with the goal of being a holdings group of actually owning companies or actually owning equity in companies, majority or minority, would be how, if I were to present these guys the next option of moving from a profit share to an actual equity in the company, whether it's real equity or it's phantom equity, how could I position that to them?
So you
Present it.
have a profit participation now based on the deal that you did. Um, and right now, so I'm not sure that you would want to change to switch to equity for a few reasons. One is taxes, because you would be taxed generally on the value of what you were receiving as equity, whether you got any money for it or not at the time that you got the equity grant. So I think that it would be better potentially to consider having an agreement like we do in our CFE deals that's either phantom equity or a profits only interest versus real equity. That would get you whatever you've agreed on as the compensation that you've got now. I would just keep that if you're happy with it as the income side, and then from the wealth building side, you would have the right to participate. You would add, if you don't already have it, the right to participate in the proceeds in the event of a sale or exit of the company,
Okay.
and whatever percentage you agree on. And you may need to have what's called a hurdle, uh, which is like the to avoid taxes in some of those situations. You have to say we're going to agree that the company is worth some reasonable amount. So let's say we agree that the company today is worth $1 million. So I'm going to get my, let's say it's 10%. I'm going to get my 10% of anything from a sale of the company that's over $1 million, which basically means that you're not going to get taxed on what you got right now. You can even have a catch-up provision. We're doing one right now on a company where the valuation is 250 million. The first 250 million that comes in, the people that have come in as, under a deal like that are not participating in when it sells, but they get caught up. So if one of them's coming in for 10%, um, after we get 250 for our sale, let's say that we got 300. So there would be no participation in the 250. Then the 10% of the 250, which would be 25, they'd get the next 25. Nobody else would. None of us would. So then that's 275. And then the next 25 million, they would get 10% of, and we would get 90. So that's like that's kind of how those deals are typically done to get everybody what they want with the least tax hassle.
Adding the right to participate in the sale,
Yeah.
correct?
I don't,
Okay.
I mean, honestly, like, I don't really want equity for lots of reasons, including, and I wish I had learned this as a result of being a brilliant financial engineer, but I learned it just by dumb luck, is if you've got an agreement on a CFE deal, and you've got let's say 10%, and the company goes out and raises money or brings in an operating team or something like that, and let's say that they're giving up another 10% of the company to that, normally you would be diluted pro rata. So if you were an equity owner and 10% of the company was sold or given to other people, you would, be diluted along with the other shareholders. But if you've got a deal that says I get 10% and they go out and do that, you don't really care because your deal says you get 10%. So it's almost like having a non-dilution provision in your agreement, which is almost impossible to get if any attorney looks at things on an equity deal, but is no problem at all to sail through legal and accounting on a CFE deal. On top of that, you probably have less liability because you're not in the
Yeah.
ownership change. So if I'm an attorney and I'm unhappy with that company, I'm going to sue the company and probably sue all the owners. But if you're not on that list of owners, you're also probably not going to get sued.
Okay. That makes sense. Then moving forward, if it still is the goal to have kind of a holdings group structure with multiple e-commerce brands underneath it, would it be best to kind of pursue more like what I have now, profits, interest, with the ability to participate on a sale, or and just remove kind of the idea of trying to get that equity, unless it's something that we acquire 100% of?
So the differentiators to me, and there isn't an answer because the answer is it depends, and it depends partially on what you want. For
Okay.
me, uh, I don't want equity for the reasons that I told you. I don't want the
Yeah.
potential liability that equity brings, and I don't want the adverse tax consequence. What I'm giving up is I'm giving up any ability to vote in what's going on in the company, even though almost every deal I do is I would have a minority interest, so I could easily be outvoted anyway. So the more valuable thing that I'm giving up is minority shareholder rights because I won't have the fiduciary duty that exists between a controlling shareholder and a minority shareholder to not do things that are against the interest of the minority shareholder. So that isn't there in my deals. And potentially, depending on how the deal is structured, I might not get long-term capital gains treatment or capital gains, and depending on what the tax law says at any given time. But I don't care about that because all of my ownership interests are done through corporation type entities, and they ultimately stop at C corporations. So there is no capital gains preference for taxes currently for corporations. So like if it was passing through and I held it as an LLC, I might be taxed at up to 50% or more because I live in California, between state and federal taxes when I sell, or if it's not long-term capital gains. So if it's a short-term deal and I didn't meet, a holding requirement. But with a corporation, I don't care because it could sell tomorrow and I'm going to pay 20% basically is my, or 21% is my top rate for a corporation. So, I like that structure better and I don't care about the minority rights and I'm not going to do a deal with somebody that I think is going to go out of their way to screw me, but I'm also protected against that by my contract and I avoid the liability chain. I mean, I basically have anti-dilution built in. To me, that seems better. So, when would I do equity? I would do equity if there was a reorganization of the company and I was coming in effectively to a situation where there wasn't a valuation, like it was, a kind of a new company that was being formed to do things, and I'm coming in and there really isn't a tax consequence at the time that we're going into it. Like, and that typically would happen where one of the partners is coming in and they're getting their equity because they're going to be bringing a whole bunch of potential clients because they're in an adjacent industry. And I do lots of deals like that. And so I'm coming in to help organize that, structure the team, and go forward with a growth plan for the company with an ideal exit at the end of it. And so there isn't a value at the time because there aren't any assets that are in there and there aren't any clients yet, even though I'm pretty sure there are going to be a lot of them real soon. So there, I think we can all come in and the people who are contributing the operations or the consulting for the equity don't really have a big tax consequence. So I might as well have the equity and have the benefit of having the minority shareholder rights and that kind of stuff. So in that deal, I probably would do it. So that's the primary contextual difference for me. Does that make sense?
Okay. Yeah, definitely. Especially because I have like the one that we just discussed, keeping it as almost as is. And then there's quite a few in the pipeline to where either they're just getting started and we would bring in all our systems for the whole business to grow it,
Yep.
um, and then get the majority or some sort of real equity in that company if
Yeah.
it's like no valuation and it's I wouldn't say startup as we kind of run from those, but they at least getting traction and it's just ours our services would come in and put that structure in across the board so that
Yes.
they can grow.
That sounds like that makes total sense.
Okay, awesome. Thank you, Roland, very much. Appreciate you.